Welcome to the August 2022 Economic Update from Beyond Wealth Advisors. I'm Dennis Bacon, the Chief Investment Officer, and this is...
I'm JC Ganote, an advisor here at Beyond Wealth Advisors.
John is normally here, but JC is going to kind of serve in his role today. So how are you going to get started, JC? What are you going to make me tell you?
Well, Dennis, let's start off with the elephant in the room these days that we hear so much talk around on the news channels. Are we in a recession or are we not in a recession?
Well, that's a great question. Certainly the headline news says that we are, which is the gross domestic product. We've had 2 quarters of negative gross domestic product, which that's a real easy thumbnail way to say that we have an economy that's not clicking on all cylinders. The reality is there's about 6 indicators that indicate whether we have a recession or not. And if they're all negative, we obviously have a recession. If 4 or 5 are negative, good chance we have a recession. So what they are is, one is non-farm payroll. Well, the truth is we've added 2.7 million new jobs this year, and including a couple hundred thousand jobs in the month of June. So that one really doesn't qualify as a recession. The second is personal consumption, real personal consumption above inflation, and that continues to be positive. We're still above inflation. I think we have 1 month early in the year that was negative. All the rest of the months have been positive. So the trend is good there. The next one is industrial production. Well, industrial production has been slightly negative in the month of June, been positive pretty much up until that point. So we did have a little bit of a trend to negative in June, but still very high levels. The next one is what they call household employment, which is really a number that has to do with the jobs out there that are working and what they're doing and whether those incomes are increasing or not. Well, the first quarter we were good, but 2 of the last 3 months have been negative. So kind of points in that direction. The other one is what we call real personal income. And this one is one where 3 out of the last 6 months have had real personal income, and that's inflation versus the income level. And so that one's been bouncing back and forth, trending a little bit negative. The one that has certainly been in the negative category would be the real manufacturing. That's manufacturing above inflation, and it's been negative. So what I would say is we kind of have a little bit of a mixed bag, certainly not a robust economy, but a lot of the indicators don't indicate that we're in a recession. I think they indicate that we may be headed towards one. That's kind of the way I would characterize it.
No, Dennis, that's really good. There's a lot packed inside of all that stuff right there that you mentioned, but that is typically all wrapped in what we typically think about a recession or not a recession. One of the interesting things I think is interesting about where we're at really with a recession or not is that the employment numbers are so low. And it's interesting that we would have such low unemployment when we could be looking at a recession. Because a lot of times those 2 things don't go together.
They rarely go. Matter of fact, I can't think of a time we've had a recession where you had high unemployment.
Exactly.
Matter of fact, one of the things I've told people about, right now we're at 3.8. If we start seeing the unemployment rate kick up above 4.5, then we may start thinking we're getting a little closer to that number.
Exactly.
So that's just my personal indicator that I kind of look at.
Yeah. No, good point there.
So,
But Dennis, from an economic perspective for the rest of this year and maybe into next year, economically speaking, where do you think we might be headed overall in the economy?
Okay, well, I like the way you said the economic. It's not the market, but it's the economy. Right. I think we're going to continue to see high volatility in a lot of the economic areas, different things trending different ways. The service economy has been improving, the manufacturing economy has been declining. They kind of counterbalance each other. I think one of the other things is the election. We're going to have the election come up, and not that election day will make a lot of difference, but it may make a little bit of difference in perception. And sometimes if people feel better about things, they don't mind spending money. Right. If they don't feel good about things, they quit spending money. Well, we've been spending money at this point, but we're starting to get into where we're spending it on credit instead of cash. So I think that will be a little bit of the thing. And as we look forward beyond that to 2023 and beyond, I think we're ultimately going to have a recession. At this point in time, everything else is so strong. I got to believe it's going to be a relatively mild recession, not like we had, in 07, 08, that type of thing. But it will be a little longer than we had in 2020. It won't be a 2-week recession, where everything just crashes and then starts coming back up. But I think that it probably will not be very long either. Just the way, and that's pretty typical actually. It'll be a more typical recessionary environment.
Well, given all that backdrop to where things are maybe headed in the future in the next few months, the remainder of this year into next year, investment decisions can look pretty hard during times like this, right?
Yeah.
And what in this type of environment that we're in right now, what types of key strategies from an investment perspective going forward for the average investor do you think we ought to be considering given this backdrop?
Well, I'm going to kick that back to you.
Yeah.
You've been in this business a long time.
Yeah.
I'd like to
Okay.
get a little of your perspective on how would you be looking at investing going forward?
Well, right now, interestingly enough, with the 10-year Treasury note being well below 3% that it had been a few months ago,
Mm-hmm.
a lot of times that bodes well for some, technology investments and things like that.
Mm-hmm.
So I think there's some element to possibly looking at growth
Mm-hmm.
in this environment with a 10-year below 3%. If it stays there, that's generally bodes well for growth. Still, value I think is a good place to be. But again, companies that have strong balance sheets that generate a lot of cash flow and still pay a good dividend.
Mm-hmm.
I think during times like this is a good place that we could find some return for our investors.
Okay, great. Well, I think that's kind of a good segue into what we kind of align with that, different perspectives on how it is. I think the bond market, we may see a little bit of increase. I don't see 10-year going above 3.5.
No.
That's just and we're at 2.7 or something like that now. I think it will get to 3.5
Yeah.
sometime, but as inflationary pressures continue. We've talked a lot about commodities the last several months. I do think that we pretty much see most of the commodity run. The question is, are commodities more at risk than equities?
Right.
I think right now I still feel fine about commodities from a risk standpoint. If we get into the point in time where we're seeing that recessionary pressure as opposed to inflationary pressure, then we would switch. That commodities would not be a good play during recessionary. They're great during inflation, but not recession. So we're kind of in that point where we're still kind of weighing that. And in the equity market, you put it real well. I think the value side, the high dividend paying stocks, very good franchise names are going to be where you want to be. Doesn't preclude being in small and mid caps because there's a lot of opportunity in those, but you want to be in investments in small and mid cap that they have strong balance sheets.
Right.
Because companies with strong balance sheets, if we go through a recession, they come out way better on this other side than anybody else.
Right.
So they're ready to really be locked and loaded, ready to go forward after a recession. So strong balance sheets, strong cash flow, strong cash balances are a great place to be.
And we've seen a lot of those strong balance sheet companies in the last 3 or 4 weeks as a result of some of these second quarter earnings kind of rolling through that have been really robust, and the money's really flowed back into those companies with strong balance sheets, strong cash flow, and opportunities to grow money, and as well as strong dividends. So, really not, Dennis, not all in all a completely grim forecast, but also not really robust as we've seen in some past years. But all in all, for the most part, it's not completely a bad year.
Right. I think as we go forward, I think we have some good opportunity. I did look at very modest growth over the next 2 or 3 years. I don't look at having a big, robust market like we've seen some of these great returns. Maybe I'm wrong. Maybe we have a 20% return, but in the next year or two. But I really think it's going to be slow and steady. We're going to be looking at those things, staying with high quality is going to be very important, no matter where you are on the spectrum of capitalization. I feel pretty good about things. You just need to be aware right now.
Yeah, I think that's a good point because it's changing constantly. And at least I know our investors, the ones I talk to in my practice, are feeling better all the time about at least what we've experienced over the last few weeks. That maybe there's not another large leg down because second quarter earnings have actually been
pretty good.
Second quarter earnings have been a little bit better than expected, and so.
And I believe we've seen most of the downturn. I kind of expect a little bit of another down leg, but it's not going to be 25. We're not going to see huge percentages down, but I do expect a little drop. But we're going to see that volatility. As we kind of wrap up the summer and everything, I think just being aware of that stuff when we go forward. I think football season is right around the corner.
Right.
I think that the training camps and all that kind of stuff are good.
Maybe that's good for stocks.
Maybe that's good for stocks. Certainly good for Saturday and Sunday afternoons.
People are kind of ready for some good football again.
That's right. Yeah. So appreciate y'all observing and participating in our cast today. And hopefully we've given you something of value. If you have any questions that have come up for you, make sure and call your advisor. And if you don't have one and want to contact us, feel free to give us a call. We'll see what we can help you with. But really appreciate y'all participating. Thank you very much.
Thank you, Dennis.
Okay.